Okay. Now, with all of this said, I want to shift the focus a little bit to, I have two trade ideas that I brought with me. And both of these trade ideas are bearish. Two trade ideas, both bearish, and both are exactly in the same sector. To start that discussion, I want to go to here. And I want to show this is the economic calendar, and here is the retail sales that came out today. We discussed this right at the top of the chat room today when the market opened, or when we started the chat room. We said, okay, take a look at these retail sales that came out for the month of May, down 0.3%, when the consensus was 0.1% increase, and the prior month of April was 0.4% increase. And even if you subtract the autos and gas, which could be extremely volatile month over month, we were still flat versus a 0.3% increase versus a 0.3% increase last quarter or last month as well. I spent some time taking a look into what actually caused this. What was some of the biggest driver of the weakness that we saw in the retail spending? And I was pulling up a lot this morning. I was pulling up a lot of the information about this, and I'll tell you what, the biggest driver, no surprisingly, and it shouldn't really be surprising because we'll be discussing this, was apparel retail. Apparel retail was one of the biggest laggards in the month of April that basically pulled the data down. And this right here also speaks for that. Lack of punch is also expected for month of May, with headline retail sales seen up only 0.1% following a 0.4% gain in April. And so that was it. A lot of other analysts they're a little bit slow this morning, but the ones that are already starting to talk about the dismal retail sales that came out this morning, they're also talking about the retail spending on the apparel producers that basically caused this crash in the retail sales. Now, I say that this shouldn't be surprising because we have already been discussing extremely tough environment for retail stocks. We have presented bearish case on departmental stores previously, right? I mean, all of our discussion about Kohl's, DDS, Dillard's, right? All of our discussions about Macy's, that it just keeps on crashing and whatnot. Target that had put buying last week as well. And then a while back we turned that conversion. We took that bearish view, and then we started basically shooting against these specialty retail stocks, plenty of specialty retail stocks. Well, I have two specialty retail stocks that previously I have avoided. I have avoided to short. Why? Because their strong management style have been able to keep those two stocks afloat, and they have been able to survive in what is clearly a very, very dismal environment. Those two stocks are ROST stores, ROST, and TJX. TJX. These two specialty retailers are specific retailers that I have avoided previously and have never recommended shorting because they have been able to navigate in tough environment rather very nicely. Well, guess what? I'm changing that view today. I think you should short both of them with impunity. Short both of them and look for a downside in both of them. The bad macro data and the bad retail environment is starting to catch up to both of them. The put buying is starting to pick up in both of these stocks, and I think that considering the fact that they have now outperformed on a relative basis to the retail sector by a very, very wide margin, I think that spread or that outperformance is going to start to shrink. So I think there's going to be some give backs in both of these names because they will have to pull back and catch up to the rest of the sector, especially when the retail environment is this bad, is this god awful the way we got the retail sales data today. So the trade over here is to buy put options in both ROST as well as TJX companies. So now let's take a look at a couple different things from a micro standpoint in both of these stocks. ROST stores, from a technical standpoint, is setting up for a massive breakdown through a very, very important technical support over here. So you can see right here, this $61 a level, or call it between $60 and $61 a level. Let's draw a line here, and this is basically your massive support. It has come and tested and tested and tested, retested so many times as support, and I think it's about to lose that. So you can see right here, tested here, tested here, tested almost here, then tested here after a huge sell-off post earnings, and then now it's about to break down. All right. This last push down towards this support was on a very, very high volume. All right, and so that's why the chances of this breaking down this time is significantly higher than it was before. You can see the volume was very high behind this. Also, this recent, it did not even make it back to the 66 level. This recent rally up to 63, and then it started to roll back again. That also happened on relatively high volume. So this is the daily chart. If you take this to a weekly chart, you're going to see a very large rounding top. Okay, so you can see this is the, you can extend this line all the way to here. Let's put it right here. Okay, so this is the massive support I'm talking about. This is basically a large rounding top, and the volume is starting to pick up as essentially the institutions start to abandon this stock. Okay, if it does break down from here, purely from a technical standpoint, you're going to expect some resistance or some support. The first layers of support come in around $58.50. So that's about $2.50 to the downside. But more important, bigger, thicker support is not going to come into play until this level, which is $55 a level on the weekly scale. So you put the line up here, and so you're looking at, you know, from here to here, a pretty significant drop of essentially, you know, that's going from $61 to $55 a level. That's a 10% sell-off essentially. That's about $6 to the downside from here to here. That's where I'm shooting for. I'm looking for a 10% sell-off in the stock, $6 to the downside, and the target would be $55 a share. All right. So that's all the technical gibberish. Now on the fundamental side of the things, here's something. So here's the same, by the way, the same lines, but on the daily chart. So here's once again, you're going to see some minor support, I should say, minor support first come into play on the daily chart around 58.50. 58.50. Here you go. Hold on a second. Let me change this line to 3 so it's a bit thicker. So here you go. As it drops from here, you're going to see first support come into play around 58.50, and then the more important support at $55 a share. So those are your targets. On the fundamental side of the things, I want to mention a couple things, because take a look at this chart very closely, and you're going to see a trend. See this earnings report that came out on February 27th, right here, and the stock gap down? They reported the same store sales in this February, on February 27, of 4%, a positive 4% year-over-year increase on February 27. Sounds pretty good, right? All right. Then fast forward to May. This was on May 18th when the earnings report came out over here. They reported in that quarter same-store sales growth of 3%. So this was 4% positive, and this was 3%. In the earnings report, management guided that the fiscal year 2017 same-store sales growth, full year 17 same-store sales growth will be somewhere between 1% and 2%. So they reported 4% same-store sales growth here, then 3% here, and then the implied guidance was between 1 and 2%, so take the midpoint of 1.5%. Now, considering that they set the bar of expectation quite high, right, 4% and 3%, but then for the full year, they're guiding 1.5% midpoint of the same-store sales growth, it starts to make me wonder if the next 1 or 2 quarter may actually end up being flat, 0, or even worse, negative, so that the full year end up being about 1.5%, because the start of the year was very, very strong. Okay, so is it possible that we may actually see negative same-store sales growth as the year progresses, or even if it's not negative, if it falls to just 1%, 1.2%, which is right where the management guided, that in itself would still look like a deterioration in trend, at least optically speaking, and it will start to basically show up in the analyst commentaries. Okay, you know what? I know that this is a very strong management. They know how to navigate tough times, blah, blah, blah. But this growth is going in wrong direction. 4%, 3%, and now we're looking at 1.5%. That is essentially the view over here. And I think we're going to start to see the trend as the summer progresses. And the next quarter that's going to be out in a while will basically confirm that particular trend. All right. So that's the whole thing over here. Now, on the previous quarter that was reported right here, I want to mention a couple things that are not usually visible. It typically is the case. If you're just going by the headlines, you're going to miss a couple things. This quarter, they posted EPS of 82 cents, right, which was 3 cents better than the consensus view. Well, good, you know, that's nice, that's pretty good. 82 cents EPS, it was 3 cents better than the consensus, until you dig deeper and you find out that there was an 8 cent, it was inclusive of 8-cent benefit because the company actually had an extra week during the quarter. They had a 53rd week in the quarter, in the last quarter. There are 52 weeks in a year. They have one extra week in the last quarter, which benefit the total bottom line EPS by 8 cents. And that was not in the consensus view. So if you simply take that 82 cents and you minus the 8, it turns out the company actually missed expectations by 5 cents below consensus view. All right. Secondly, they guided for the full year of, or for the next quarter, for the second quarter, which we are in currently, and that will be reported sometime in late July. They guided us 73 cents to 76 cents based on 1.5% comp growth. That was also just above the consensus view, but not huge. A question was asked in the conference call, how come the guidance of the same-store sales comes down from 3% to 1.5%, yet the EPS guidance does not come down sharply or does not come down as much. And management basically suggested that they are managing inventory well, so they're basically looking for improvement in margins. And I think that precisely is where a disconnect comes into play. If you're going to make a case that same-store sales growth is cutting down, you really need to very aggressively manage the inventory before you start to see slippage in your earnings per share as well. Your operating cost is also going to go up, right? So it has to, because there's a lot of it is a fixed cost structure. So the bottom line is this, that I think that they provided too optimistic guidance for this quarter based on what they said about the same-store sales growth. So either they were lying about the same-store sales growth, or if same-store sales growth is going to be realistic at around 1.5%, then I think that there's a risk that they're going to miss on EPS expectation when they report next earnings. So that's the message over here. And my assumption at this point is, based on everything that I read, that they're going to miss EPS expectation, especially after we got this kind of horrendous retail sales report that came out today, which is speaking for incredible weakness in the entire sector. By the way, this retail sales that the miss that we saw today shouldn't be surprising, because Bank of America last week did its own checks on the credit card spend. You know, the Bank of America is the largest bank in the nation that has 10% of nationwide checking and savings account deposit. So it has a very good view on the card spending by the consumers. And so based on their own checks, they saw the similar data, deterioration in apparel. And that also trickles down to not just ROST stores, but basically the entire sector. One last thing I want to mention before I give you the trade idea is that something interesting is happening. I'm not the only one that is basically looking to short ROST stores. If you go to if you look at the short interest, you're going to find very interesting trends. Here you go. This is not a type of stock that people like to short. Okay, the retail is not the kind of stock that people like to short. The bears don't like to touch it. As I mentioned, it's pretty strong management. But take a look at this green line. It has been ripping higher since March or April, precisely from the very first time. From February, this has been ripping higher. Precisely from the very first time this year, when they reported 4% same-store sales, and then it decreased to 3%, and now they're guiding 1.5% to 2%. As those same-store sales expectations are coming down, the short interest is ripping higher, and it's now approaching 10 million shares. About 10.2 million shares are sold short. That's the highest level we have seen in the company. in this is as of the end of May, by the way. End of May, there were 10.2 million shares sold short. That's the highest level in the company's history, basically in last 3 years. And this chart confirms that trend. All right. So what is the play over here? Now here's something interesting. If you go to ROST stores, looks like you're already buying these in front of me. The trade is to buy straight August 60 puts for $1.90 or less. So here you go. I just gave you the trade idea. So at least you're not waiting for it. Buy straight August 60 puts for $1.90 or less. All right. So that's the trade idea. But now let me show you. You see the volume here, which is 1,800. Some of this is you guys buying. 1,500 of that was bought in a single lot size this morning, right after the market opened. So when the retail sales came out, and then 20 minutes or 15 minutes after the market opened, somebody bought 1,500 of these in a single lot, and they paid $1.50 for it. So basically, the price has already moved since then. They paid about $1.50 for it, and so that's about, what is that? 1,500 times $1.50, right? So 1.5. So that's approximately $225,000 bearish bet. Unfortunately, stock has been declining intraday since then. I've been meaning to bring this idea to you in the webinar, but ever since then, the stock has been declining all day. So by the time now we're finally doing the webinar, the price has gradually already moved up a little bit, and now we have to pay up to $1.90 to buy these puts. All right, but basically 1,500 of these were bought today, right after retail sales came out and the market opened. But here's something interesting. If you look at this open interest, this 26,000 open interest in this, and you you zoom this and you look at what happened, you're going to see on the daily chart that this is the 1,500 volume that showed up this morning for $1.50. Well, last week on June 8th, right? June 8th was Wednesday. They bought 2,500 of these contracts. I was looking at this earlier. They bought 2,500 of these contracts for $1.70 last week on Thursday, June 8th. So they bought 2,500 then. Then today, after the retail sales came out, they bought another 1,500 of these for $1.50. So between 150 to 170, they have accumulated approximately 4,000 of these contracts. So 4,000 times 100 times, taking an average price of $1.65. About $660,000 worth of put options have been accumulated in these August 60 puts. And they're betting that it's going to go down, and basically it's going to go below 60. Now take a look at the chart again, just to kind of show you. This is, ROST stores right here. So basically they're looking for this breakdown through 60. This is where they're buying puts, and this is the massive support I keep talking about. They're looking for a breakdown, and as I mentioned, the first target is 58.50, and then the second target would be 55 all the way out here. And since they're buying August puts, that's plenty of time, right? You got 3 months basically for this to work out. So that's the play. The play here is buy straight August 60 puts for $1.90 or less. Next one, TJX. On the technical side of things, TJX is exactly the same thing. It gapped down sharply, and it basically came back. Right, this was after earnings, a huge gap down, very high volume liquidation behind this, and then light volume. Take a look at the volume behind this. Sometimes I'm telling you, you guys have to pay attention to the volume, which is why I focus too much on the volume. So here's a nice zoom in picture of TJX telling you what is going on. All right, and very simple. Reported earnings. I will cover earnings in just a little bit under the fundamental case, and I'll show you what happened. But basically, it was a terrible quarter, and the guidance was lowered. Stock kept down on very high volume, and then volume dried up as the stock gradually made a comeback, partially filled the gap, stalled right where which was previously support became resistance, right? So stalled right here at $76 a level on light volume retest, and then started to roll over again, and the volume started to pick up again. Once again, so every time when it rises, the volume dries up. Nobody is buying. It's dead cat bounce. But every time it starts to sell off, volume starts to pick up. It's under liquidation. That's what the chart is telling you. The stock is under liquidation, and now it's starting to basically break down from this bear flag again. Take a look at the weekly chart. You'll see the same picture. All right. So if I go over here, this is similar to ROST chart, more or less. If I draw on the weekly scale this price level, this is a massive volume of price support right here, and basically it is starting to lose that. It tried here. There were a couple overthrows, but it tried here, tried here, tried here, tried here, and then finally look at the volume behind this, huge volume behind this on this sell-off. And now it is finally starting to break down. So when you have a push down like this on volume, that tells you that there's a breakdown coming in front of you, and basically they're abandoning the stock. And that's what's happening over here. So you can see that this is starting to roll down. And so the next most logical support that comes into play will be at $69.70, which is right here on the weekly scale. Okay, so let's turn this into a dotted line so we are pretty clear. That would be your first target. I call it round figure $70. All right, so $69.70 or so, or $70 basically. But basically, there's about $3 to downside from here. But you know what the thing is about ROST store is here's where it gets interesting while we're looking at the technicals on the chart. ROST stores, at least, you know, the ROST stores in the last quarter was able to produce a positive same-store sales growth, even though it has been decelerating for the last 2 to 3 quarters and may potentially be on its way to turning negative. TJX, however, okay, had a disaster quarter last time. TJX is actually on a relative basis is doing worse than ROST stores and actually cut guidance for its EPS. The point is that on a technical side of the things, it may seem like that this is only $3 to downside from the $73 currently to $70. But I wonder if the story is going to, fundamental story in this one is going to get worse enough that this volume of price support won't even matter. It's going to cut through this like hot knife through butter. Okay, so it's going to cut through this like it doesn't even matter, and it's going to be on its way to 65, basically retesting this massive support that's not going to come into play until all the way down to 65. I wonder if that's what we're going to be looking at down the road, and this 70 won't even matter. But still, I just wanted to point out that there will be some small support around $70 first, and then we're going to be looking at a more important support at $65 a level. So from going from 73 to 65, that's about 11-12% sell-off. That's good $8 to the downside from here. So that would be my ultimate target at 65. And if it breaks that, things are going to get, then you have to start looking at long-term 5-year weekly chart. Then things are going to be, I mean, if it starts to break this, things are going to get really ugly really fast at that particular point, because then people will start to question the entire bull case in this one. And you know how it typically goes. You know, people start to form their fundamental opinion based on technical price action, which is exactly what I advocate. Do not do that. Do not do that. I say this all the time. Do not mix your fundamental opinions with your technical views, okay? They are independent of each other. Evaluate the stock independently, all right? But that's how the market works, you know, because by the time the stock is already crashing and everything is coming down, that's when they will come in and say, oh, by the way, fundamentals are deteriorating. Well, thank you very much. You could have told me that 10-15% ago. But that's not how the market works, all right? Okay, so so this is the TJX chart. I think it's heading for a breakdown, and your first target is 70, and the second target is 65. On the fundamental side of things, I just want to show a couple of things. Here is a file from Bank of America, and this was from May 16, basically covering the earnings report. And basically, they're expecting second half growth rate to accelerate. I don't know how they're going to happen. In this quarter, basically, this is after the last earnings came out on May 16. They talked about the first quarter was very disappointing, but hey, we're optimistic. We're going to see second half EPS growth accelerating. The total, the EPS was 82 cents versus 78 cents based on FX hedging and whatnot. The comps rose only by 1%, and it was driven by traffic, even though the price of actual commodity actually, or price of goods actually came down. So the ticket prices came down, but the traffic was better, maybe because there were more promotional sales that brought more traffic in. TJX outlook for second quarter was 81 to 83 cents, below consensus due to a 4% FX headwind. Now the consensus was, I can just show you, instead of going through all of this, I'm just going to show you my summary of it. Maybe that will make it clear, which is right here. So this is the this is on May 16 that I posted in chat. EPS was a beat, slight beat because of FX. Then revenues missed. Same-store sales was only 1% versus 1.5% estimate. That was a miss. And Q2 guidance was 82 cents versus 92 cents estimate. So that was also lowered. And so if that was on May 16, I wonder after today's disaster retail sales, especially driven by apparel, how bad this is going to be. All right, how bad the Q2 is going to be. Anyways, the play over here is very simple. Go to the option market and buy. In this case, we're going to have to go to October. If we don't have August available, and July, in my opinion, is not going to be enough to cover the next earnings cycle or see the bear case actually work out. So we have no choice. We're going to have to go to October. And in this case, I would like to go straight 70. October straight 70 strike puts for $2.05 or less. All right, so they are slightly further out of money. You might be wondering about that because you could go with 72.5 strike puts, and I think that would be perfectly fine as well. But I think the 70 is the level because I'm looking for a breakdown through 70 and a move down all the way to 65. So I think 70 will be fine as well. Plus, I'm willing to go slightly out of money because we're going with October, which is way out there. This is 128 days out. So, okay to go with October 70 strike puts for $2.05 or less. Buy those and just basically look for continued sell-off in this with the first target 70 and then ultimately to 65. I can also want to show you one thing, the similar picture that I showed under ROST discussion. Here is the short interest in TJX, same exact picture. All right, I mean it goes up and down in a zigzag format, but if you notice this green line, which is the short interest, you'll notice that it always seems to starts to back off. I mean short interest always seems to start to come back down, you know, when it reaches this level right around here. Well, not this time. This thing is ripping. This is the higher short interest. Basically, the chart of short interest itself is breaking out. So what does that tell you, right? The chart of short interest itself is breaking out. So this green line is just broke out sharply. The short interest has drastically increased in April and May, and it says now, what, 4-year high or 3-year high, the highest level basically going back to the 2014. So that's a 3-year high or something. That also gets my attention. All right. So those were the two plays. Short both of these retail stocks with put options, and after the very, very bad retail sales, and then we'll see how it pans out. All right, I will take it from here. Open for questions.
All right. Do you have a price for the 7.25 puts if anybody wants to go with that on the TJX?
Yeah, right where it's trading right now, you could just buy straight for 72.5 puts, October 72 for $3.10 or less. I mean, it will give you a slightly better delta. It'll be 0.46 delta versus 0.35. But I mentioned this previously that especially when you're buying leap calls or leap puts, right? Especially when you're buying something that is leap, which means that the theta decay is not an issue, right? You don't have to worry about theta decay accelerating in your case. And generally, the rule of thumb is that I'm willing to go out of money as long as I'm still getting 0.3 delta or higher. Let me repeat that again. If you're buying leap calls or leap puts, you're making a directional play on a stock, all right? And theta decay, because it's leap, theta decay is not an issue. Generally speaking, as a rule of thumb, I'm willing to go up to the strike that will give me minimum of 0.3 delta or higher. Well, in this case, the October 70 puts have a delta of 0.35, but the 67.5 puts will have a delta of 0.25. Well, that's too low. 0.35 will be sufficient. So I'm okay to go with 70 strike. But yeah, if you want higher delta, you'll get more, you spend more, but you'll get more boost if the stock starts to crash. Perfectly fine to go with October 72.5 for 310 or less. Oh, by the way, while I'm at it, I forgot to mention this earlier. So just like in ROST stores, just like you saw, we mentioned that this morning there was a block of 1,500 of these August 60 puts that was bought that started this chain reaction. I want to mention in TJX a little bit. If you see this very closely, this is how I dive deeper into these. If you go to July, you see this 4,500 open interest right here in July 75 puts. If you go here and you basically look at the history behind these July 75 puts in TJX, you're going to see a very big spike in volume here, and that was yesterday. Yesterday, June 13. Today is June 14. This was yesterday. All right, June 13. Well, let's go to Activity Tracker, and you're going to find something very interesting. Here is the snapshot of those July 75 puts. Over 3,000 of these July 75 puts in TJX were bought yesterday. You can see right here, July 75, 75, 75, and then finally they were buying it for $2.10 all the way to $2.15. You can see that the biggest block of 1,000 contracts, was bought for $2.15 offer when the bid and ask was 2 to 2.15. All right, and so they bought these puts yesterday in TJX. They were already buying these puts yesterday, and I completely missed. Somehow I did not mention this in the chat room. Completely overlooked this, and they were already anticipating a very, very weak retail sales today. But here's something more interesting. After I saw that this morning, that I started digging around, and I found an interesting file from Bank of America that that came out. Guess when? It came out yesterday, June 13, right here. And in this case, they talked about the sectors and the stocks on the move. They talked about which stocks are about to break down and which stocks are about to break out. This was issued yesterday, so maybe somebody was reading it. If you actually scroll in this file all the way down to page 21, there you go. Boom. You're going to find a discussion on both stocks. ROST stores, risk of top and drop to $52 to $50 level. TJX, risk of top and drop to $64 to $60 a level. So here's Bank of America technical team making exactly the same case. There's the drop they're looking for, and there's a drop they're looking for in TJX. This file came out yesterday, and yesterday somebody bought $2.10 multiplied by 100 times 3,000, approximately $630,000 worth of puts were bought in TJX yesterday, and $660,000 worth of puts were bought in ROST stores since last week since last Thursday. So anyways, I know I just added some more color to this, but I just wanted to point that out because I missed that earlier.
Okay.